Welcome to the Deep Dive. Today we're digging into One Ltd, looking at their recent financials, Q4 for the 24-25 fiscal year, and their strategic direction.
That's right. We've got the statements, the auditor's report, board decisions, and, importantly, the earnings call transcript.
Our mission really is to pull out the key insights from all this material. What does it tell us about Angel One and maybe, the wider market?
Exactly. We'll hit a few key things. Definitely the impact of those new F&O regulations, futures and options on their trading volumes, their revenue.
Yeah, that's crucial. And how they're responding, right? They seem to be investing heavily despite maybe some short-term pain.
Precisely. Strategic growth investments. Plus, their big push into new areas, credit, insurance, wealth, even asset management.
Right. And we can't forget the leadership changes, some big names coming in. And of course, the numbers, financials, dividends, all that good stuff.
Okay, let's dive in. First up, those regulatory changes, the F&O impact.
How significant was it?
Well, according to Mr. D.H. Talker on the call, pretty noticeable. Order volumes were down 22.4% compared to the previous quarter.
Wow, nearly a quarter drop.
Yeah, landing at 327 million orders. And that meant, fewer active clients trading. Things just felt a bit muted.
And I assume that hit the bottom line directly.
It did. You see it in the financials. Sequentially, gross revenue fell 16.3%, and net revenue was down 15.7% in that fourth quarter.
Okay. And their core business, the broking revenue.
That took an even bigger hit, actually. Gross broking revenue dropped 22.6% from Q3. So yeah, a substantial shift there.
So broking, their main engine, definitely slowed down. But I noticed, looking at the details, it seems like F&O isn't quite as dominant in their revenue mix as it used to be.
That's a really interesting point and something listeners should track. Mr. Vinny Agarwal pointed out that F&O's contribution to gross broking income fell to about 77% in Q4.
77%. And before that?
For the previous 11 quarters, it was consistently somewhere between 81% and 87%. So that's quite a drop.
It suggests maybe these regulations hit them harder, or perhaps their client base reacted more strongly than some others.
That's a possibility. It's a significant change in the mix.
So where did the slack get picked up? If F&O's share dropped, what rose?
The cash segment actually increased its share to 14% of gross broking income. And commodities also stepped up, reaching 8.6%.
Okay, so a bit more diversification within the broking income itself, maybe a sign of resilience?
Could be. It shows they're not entirely reliant on just one segment within broking, even if F&O is still the largest part.
Right. Now, despite these, let's call them headwinds, the management, especially Mr. Takar, sounded pretty, positive long-term.
Yes, their perspective is key here. They view these regulatory changes as fundamentally constructive. Good for the market in the long run.
Even with the short-term dip?
Even with that, they see it as a temporary recalibration. The market, the traders, they need time to adjust.
Okay. And what's their outlook for this coming year, FY26?
They're expecting things to stay a bit, subdued in the first half. Client activity might be slower.
But they expect a recovery.
Yes, they're projecting things to normalize by the fourth quarter of FY26. Getting back towards previous levels of activity and profitability, that's their expectation.
That long-term view really frames their current strategy, doesn't it?
Right.
It explains why they're pushing ahead with growth initiatives.
Absolutely. Mr. Takar was very clear. They remain committed to investing for growth, even if it impacts short-term profits.
And this growth isn't just about broking anymore. It's about building a much bigger platform.
Exactly. A comprehensive financial service platform. We're talking credit, insurance, fixed income products, wealth management, asset management, the whole spectrum.
That's a huge undertaking, a major diversification.
It is, and they're backing it with serious investment. Look at the IPL sponsorship.
Yeah, I saw that figure. Nearly 1,500 million rupees for FY25. That's massive.
1,489.63 million. Yeah, it's a significant outlay.
What's the rationale there? Just brand building.
According to Mr. Saurabh Agarwal, it's viewed as a medium to long-term play. Enhance visibility, boost brand recall nationally.
Makes sense if you're trying to become a household name for more than just trading, especially as you roll out these new services.
Precisely. And beyond the big splashy sponsorship, they're pouring money into technology.
Right. The tech backbone must be crucial for all this.
Absolutely. Mr. Amish Ken spoke about using advanced analytics, AI, machine learning. It's all about improving that digital experience for the client.
So things like personalization, better risk assessment.
Exactly. Personalized journeys, more relevant product suggestions, using data to understand client needs better. It's not just talk. It's about building smarter systems.
Like tailoring investment ideas or speeding up loan decisions using that AI.
That seems to be the direction, making the platform more intuitive and efficient for users.
And how are they scaling this up? Especially the new ventures like credit and insurance partnerships?
Partnerships are definitely key. They've already got 6 lenders lined up for credit distribution and 5 insurers for the insurance side.
And onboarding banks too, I read.
Yes, Mr. Ken and Mr. Agarwal mentioned that. Bringing banks onto the platform helps them scale much faster. It also shows some confidence from established players in what Angel One is building.
Okay, let's zoom in on these new businesses. Asset management first, the AMC. They launched some funds recently, right?
They did. A successful NFO new fund offer, Mr. Heyman detailed it. 2 passive products initially.
Passive, meaning index tracking.
Right. The Angel One Nifty Total Market Index Fund and an ETF tracking the same index, actually the first ETF in India to track that particular broad market index.
Interesting. And a debt fund too.
Yes, the Angel One Nifty 1D Rate Liquid ETF growth. So equity and debt options right out of the gate.
And how's the uptake been? Early days, I know, but any signs?
Pretty encouraging, it seems. They pulled in about Rs, $740 million in assets under management, AUM, across those 3 funds fairly quickly.
740 million. Okay.
And importantly, they highlighted participation from over 8,800 different PIN codes across India. So broad reach, not just concentrated in big cities.
That's quite widespread. Okay, moving to wealth management, Ionic Wealth, they call it. Who are they targeting here?
A different segment. Mr. Shrikant Subramanian laid it out. Focus on asset allocation for 2025, targeting ultra-high net worth individuals, people with over Rs 25 crore net worth, and also HNIs, high net worth individuals, between 1 and 25 crore.
So wealthier clients needing more sophisticated advice.
Exactly. They've built an omni-channel platform. There's a direct-to-consumer app, but also dedicated relationship managers for that personal touch.
A2C plus human advice. How's that performing? AUM client numbers.
Ionic Wealth is managing over 3,790 crores in AUM already.
Wow, that's substantial.
Yeah, about ours. 3,327 crores actively managed, the rest in custody. And they're serving over 680 clients in this HNI, ultra HNI space.
And they mentioned accreditation and fractionalization.
Yes, focusing on qualified advisors and potentially offering fractional ownership in assets, which could open up different kinds of investments.
Interesting. Okay, third area, credit distribution. Big potential in India, right?
Huge potential. Mr. Saurabh Agarwal talked about strong demand, especially for unsecured loans. They've already dispersed over Rs 7 billion cumulatively as of March 2025.
7 billion. That's not small change.
No. And they're building their own tech here, a proprietary lender allocation engine, using AI and ML for risk modeling.
So trying to get smarter about matching borrowers and lenders.
That's the idea. Improve efficiency, manage risk. They're aiming for a significant market share long-term, given how underpenetrated credit is in India, especially with digital access improving.
And finally, insurance distribution. Still early stages.
Yes, currently in a beta phase, they've partnered with 5 insurers, starting with motor insurance.
What's the focus there? Just selling policies?
The focus seems to be on a seamless digital experience, making it easy to buy and manage policies online, offering personalized options, leveraging tech again.
Okay, that covers the new ventures. Let's shift gears to leadership and governance. Some big appointments.
Very significant ones. Mr. Ambarish Kanagri coming in as whole-time director and group CEO.
His background is quite tech-focused, isn't it?
Yeah.
Google Pay, Myntra.
Exactly. Google Pay APAC lead, Myntra leadership, Cisco, brings a lot of experience in building large-scale tech and consumer platforms. That signals their intent clearly. Effective mid-April 2025.
A clear signal about the digital future. Any other key hires?
Yes, Mr. Rohit Chatter, appointed as Chief Data Officer, another heavyweight 29 years in AI and data, experience at places like Walmart, Adobe, Yahoo.
So a big push on data strategy, too.
Definitely. While his exact start date isn't in the board notes, it's implied he took over after the previous CDO left end of April 2025. Underscores that commitment to data-driven decisions and product development.
And on the governance side, auditors, structural changes.
KPMG appointed as internal auditors for FY26, pretty standard. One interesting point. They withdrew that proposed scheme of arrangement?
Ah, yes, the one to transfer some businesses to subsidiaries.
That's the one. Announced in February, now withdrawn. No specific reason given in these materials, but it's a change in plans regarding their internal structure.
Worth noting. And crucially, the auditors gave the main financials a clean bill of health.
Correct. The group CFO's declaration confirmed an unmodified opinion from the statutory auditors on both standalone and consolidated results for the year ended March 31st, 2025. No major red flags raised in the report.
Good. Okay, let's hit the financial highlights for the full year then. Consolidated numbers, what jumps out?
First, the dividend. They've recommended a final dividend of Rs 26 per share for FY25.
Subject to shareholder approval at the AGM, of course.
Of course. Asset base grew significantly, total assets up to over Rs 1,010,000 million from about Rs 85,600 million the year before.
Strong growth in the balance sheet. What about the top and bottom lines for the full year?
Total revenue from operations for FY25 was up 22.6% year-on-year, hitting Rs 52,384 million. Healthy growth there.
And profit?
Net profit after tax, PAT, grew more modestly, up 4.2% year-on-year to Rs 11,721 million for FY25.
So revenue grew faster than profit. Reflects those investments and maybe the Q4 slowdown.
That seems likely, especially when you see the Q4 PT figure itself was Rs 1,745 million, which was that 38% drop from Q3 we talked about earlier.
Got it. How did earnings per share track?
Basic EPS for FY25 came in at Rs 130.05. That's actually slightly down from Rs 134.21 in FY24.
Okay, so profit growth didn't quite keep pace with share issuance or other factors affecting EPS. But net worth looks strong.
Very strong. Jumped significantly to Rs 56,391 million from around Rs 30,386 million the previous year, building a solid equity base.
Any key ratios listeners should be aware of? Debt levels, coverage.
Yeah, a few. Debt equity ratio improved, down to 0.60 times from 0.83 times. Suggests less reliance on debt relative to equity.
Which is generally seen as positive, right? Lower financial risk.
Generally, yes. Their debt service coverage ratio was strong at 7.15 times. Interest service coverage ratio at 6.44 times indicates comfortable capacity to meet debt payments. Current ratio was 1.09 times, showing adequate short-term liquidity.
And we have to mention that IPL expense again in the context of overall costs.
Absolutely. That Rs 1,489.63 million expense in FY25 compared to just Rs 227 million the year before, that's a major increase in their other expenses category and clearly impacts profitability metrics.
Okay, final area. Clients. Acquisition and activity. How did they fare in FY25?
Strong in acquisition. They added 9.3 million gross clients during the year.
9.3 million. That's impressive.
It is. And interestingly, around 90% of those new clients came from outside the major metro areas, Tier 2, Tier 3 cities, and beyond.
So still penetrating deeper into India.
Definitely. Their total client base reached 31 million, up 5.1% just in the last quarter. Good growth momentum there.
But what about active clients, the ones actually trading?
That's where you see a slight dip, likely linked to those F&O changes.
Yeah.
Their NSE active client base slipped 2.3% quarter-on-quarter to 7.6 million. Still ranks them third overall, though.
Okay, so fewer of the existing base were actively trading, perhaps. How about market share?
Mixed picture there. Their share of total demat accounts in India actually increased slightly to 16.1%. And their share of new demat accounts opened was strong, up to 21%.
So still capturing a good chunk of new market entrants.
Yes. But their share of the active client base dipped marginally to 15.4%, and their share of retail equity turnover also saw a small decrease to 19.9%.
So summing that up, great at bringing people onto the platform and opening accounts, especially from smaller cities, but saw a bit of a temporary slowdown in actual trading activity in Q4, probably due to the regulatory environment.
That seems like a fair summary. They're growing the user base significantly, but converting that into active trading faced some headwinds recently.
Okay, let's pull it all together then. What are the key takeaways for our listeners from this deep dive into Angel One?
I think the main thing is seeing Angel One in transition. They're actively navigating these regulatory shifts while making a very deliberate, very strategic pivot towards becoming a broad financial services provider.
Moving way beyond just being a broker.
Exactly. The heavy investments in new areas, asset management, wealth, credit, insurance, plus the big spending on brand like the IPL and the tech upgrades, it all points to that transformation.
And accepting some short-term profit impact for that long-term vision.
Right. That, combined with the regulatory impact, explains the recent dip in profitability. But management seems confident, and the leadership changes, bringing in people like Kang and Chatter, really reinforce that tech-driven, expansionist strategy.
And what does Angel One's story tell us about the bigger picture? The Indian financial services landscape.
It really highlights a few key trends, doesn't it? One, the undeniable importance of technology, digital platforms, AI, personalization are becoming table stakes.
Not just optional extras anymore.
No. Two, this drive towards consolidation or offering comprehensive solutions. Companies want to be the main financial hub for their customers, offering everything from investing to lending to insurance.
Capturing more of the customer's wallet.
Precisely. And three, the continued financialization of India, reaching deeper into those tier 2 and 3 cities, bringing more people into the formal financial system. Angel One's client acquisition numbers really show that.
And their focus on passive funds and digital credit reflects wider market demands, too.
Absolutely. Those are growth areas across the industry.
Okay, let's leave our listeners with a final thought to chew on. As Angel One builds this all-encompassing financial platform, what does that actually mean for the user?
Yeah, that's the interesting question. On the one hand, maybe more convenience, everything in one app, potentially seamless integration between services.
Could be. But what are the potential downsides or challenges? Does consolidating everything under one brand limit choice, does it create new kinds of risks?
And how does this push for consolidation change the competitive game in fintech? Will we see more players trying to build these super apps, or will specialization still win out in some areas?
Lots to think about. How will this impact your experience and the choices available to you as these platforms evolve? Something to ponder. Thanks for tuning in to this deep dive.